Hi, everybody. Good morning and welcome to today's AAPL emergency meeting, State of the Private Lending Market. Today, we'll be talking to you about some updates with what's going on right now, especially with COVID-19. We have a great slate of panelists here who will be talking. So without further ado, we will get started. But before we get going here, I do want to go over a couple of housekeeping items. First, this presentation will be recorded and the slides will be available after the presentation. So no need to ask about whether you'll have access to the recording or the slides. They will all be provided to you. At the bottom of your screen, there are several different tabs there. One is a Q&A, one is to raise your hand, and another is a chat. If you have questions at the end of this presentation, we will have a Q&A session. Feel free to use the Q&A to ask your questions. Feel free to ask directly to a specific panelist. So for example, if you have a question for Eddie, feel free to say this question is for Eddie and ask the question. We'll do our best to get through all of the questions at the end here, but we do have a hard stop at noon. So if any questions are unanswered or we don't get to your question, feel free to reach out to us and we can do our best to answer that for you. And yeah, so just a quick reminder, use the Q&A button, don't use the chat or the raise hand option because we won't be monitoring that. So without further ado, feel free, Eddie, take it away.
Awesome. Thank you so much, Melissa. Again, Eddie Wilson here, the CEO of the American Association of Private Lenders. Really excited to bring these series of webinars and Zoom calls to you because I think that a lot of the content that we've been bringing over the past month or so on these have been so relevant, and we've had so many people respond and thank us for the panelists that we've had on. And so again, today is no exception. We have a really exceptional group of people that are going to bring to you topics and conversations such as, what are some of the revised underwriting criteria lenders are using? How are lenders managing their forbearance requests? When do lenders anticipate going back in the marketplace, so on and so forth. And so we have a lot of those type of topics that are going to be addressed today, and I'll let each one of the panelists talk specifically about their field. But by way of kind of introduction, again, thanking you for joining us today and just making sure that we do answer the questions you have. We will monitor those, like Melissa said, and we'll answer them as best we can. If there is a question that's asked that we don't get to during this, we'll, after the fact, go back to you and try to answer those as best we can. If you haven't been to the AAPL website recently, if you are a member, I know many of you are, make sure that you go and update your member profile. You can see that on the slide right there. It says aaplonline.com/member-dashboard. And we have literally thousands of people coming to the site right now looking for capital. And so it would be in your best interest to make sure that your member profile is updated and you have your current lending criteria and terms and things like that on there, because they're coming to there very, very often to make sure that they can find who is lending in their state and they can find opportunity there. If you haven't been to the page on our site that is directed specifically towards helping those of you with the COVID-19 issues, you can go to aaplonline.com/COVID-19. And you can register there, and then it'll keep you updated on all these webinars and Zoom calls we're doing. Also, we have a ton of articles and curated content, some PowerPoint presentations on there, and just helping you kind of understand what the state of the market is, what other people are going through. And then also there's a form on there. I know many of you, if you were heavily reliant on the capital markets and you're kind of in this kind of shutdown state and looking to deploy capital, we have a lot of people that are members that also have discretionary funds that are looking to deploy capital. And so what we're trying to do is we have a form on there that you can go and register for whatever it is that you need. We're using Jurassic as the intermediary there so that we as an association aren't generating leads for our clients, but we send that kind of through an intermediary there at Jurassic so that they can funnel the request to those who need different items. So Again, thank you so much for joining us. Obviously, we've got a lot of great panelists and guests today, and I'm going to go ahead and turn it back over to Melissa, and you can bring on our next guest.
Excellent. Thanks so much, Eddie. So without further ado, we have Alan with Share States. Alan, would you like to introduce yourself? Sorry, Alan, you're muted.
There we go. Sorry about that.
No worries.
So, Alan Scheinfecker, one of the co-founders and CEO of Share States. We are an online marketplace lending and private lending platform, essentially providing two services, providing short-term 12 to 24-month bridge loans, as well as term loans to real estate speculators and developers. Nothing consumer-related, all investor purpose. Facilitating residential, multifamily, and mixed-use transactions. And on the other side, we also have an investor marketplace where we're selling whole loans to institutional investors of various types, all shapes and sizes, anywhere from a couple $100 million under management up to several $100 billion under management, as well as the marketplace component of our business, which is comprised of smaller, unlevered institutions, as well as retail accredited investors. Been in business now for a little over 5 years. We've originated approximately $2.5 billion in that time, and actively looking to build our business, hopefully in a surviving post-COVID-19 world.
Awesome. So to kind of, went away from full screen. So the first question that I have here for you, Alan, are what are your new lending parameters, if any, or how have your underwriting criteria changed during this time?
Yeah, so over the last 60 days, there's been a pretty big question mark on that. We've had a number of conversations with our various institutional partners, and I think we've pretty much settled on 3 different changes. We've been pulling back on our loan to value, loan to cost, and loan to after repair value parameters about 5 to 10 points, depending on the asset class and the product. So for example, whereas for some of our VIP borrower relationships who were previously going up to 85% loan to cost, we're now down to 80% loan to cost. Where we were previously at 80% as is LTV, we're now down to 70 to 75 as is LTV, depending on the property type and development phase. We've also increased our rates. It's a function of supply and demand and just limited capital in the space. So we have starting rates now really in the 9 to 10% range, whereas about 60 days ago, we were in the 7.5 to 8% range as a starting point. And I'd say the third big change is an inclusion of interest reserves. And that, again, that'll vary, but anywhere from call it a 3 to 6, possibly up to a 12-month interest reserve, depending on the specifics of a project. Other than that, everything else has pretty much stayed the same for us in terms of asset classes covered, loan sizes, etc.
Excellent. So also during this time, your borrowers are really asking for forbearances. What's the number of forbearance requests you've received, and how are you managing this process?
So we, as I mentioned before, so we've originated about $2.5 billion in volume. We're probably at this point servicing about 1,500 loans in-house. On that, we've received less than 100. I want to say we're probably at somewhere around 80 formal requests for forbearances. We've only granted 2 of those thus far. We've put together basically a forbearance request form that requires the borrower to make certain certifications and provide relevant documentation in the form of bank statements and otherwise. The reason for that is unfortunately, there are some borrowers out there that are looking to opportunistically, take advantage of the situation. We're trying to mitigate that risk to our investors, so we do have to properly diligence that process.
Understood. Next kind of question here is, when do you anticipate being able to lend significantly again?
Yeah, so leading up to this, we were closing and selling just about $100 million a month in loan volume. Today, we're really focused on our top 5 to 10 borrowers. These are guys that we have extensive relationships with, that we've been lending to for the last 4 or 5 years. We built personal relationships with them, sat down, had dinner with them, just people that we intimately understand their businesses. I think as far as, when we can significantly lend again, it's really a question of, it's a relative question. I think we start opening back up to borrowers outside of our top 5 to 10, probably sometime around June, July. I think the sentiment in the market is starting to change a little bit. So it's been very negative in the investor community for the last 60 days. We're starting to see some investors come back into the space now, and others that have plans to re-enter the space in the next 30 to 45 days. So as soon as that settles out, we'll be able to open back up to a broader audience of borrowers.
Understood. And then last little question here. What other significant challenges are you working through right now?
So for us, it's always been about running a profitable business. When we first got into this sector, there, as a crowdfunding syndication company, private lending company, there were hundreds of what I would call marketplace lending platforms. And then eventually that kind of transitioned into hundreds of private lenders. And we've always tried to do is really not go the VC or private equity route where we're raising capital for the business and, blowing out this ridiculous online marketing expense and running at a loss just for the sake of growth. We've been thankfully operating profitably since 2015. So the challenge for us right now is continuing to, at the very least, break even. So with the current volume that we're closing, and just, certain changes that we've made to the organization, thankfully, we've hit an equalization point on that. So while we aren't making a ton of money right now, we aren't losing money either. And it's really for us just about, surviving this current market and, hopefully going back to doing what we do best in, June or July. I think there's always a pendulum swing in our business. So sometimes you have more borrowers, sometimes you have more investor capital. And that's always been difficult to manage growth at consistent paces on both sides. Right now, there's definitely a capital shortage. So, we're focused on the capital market side, on outreach to various institutional investors, onboarding new institutions. And we have a couple of great prospects that we're working on now that we're excited about. So that's really where the focus is for us.
Awesome. Thank you. I appreciate your perspective there, Alan. So next up, we have Paul with Residential Capital Partners. Take it away, Paul.
Coming off mute. Thank you, Melissa.
Yep.
My name is Paul Jackson, and I'm one of the founding partners with Residential Capital Partners based here in Dallas, Texas. We've been a private lender for the last decade, primarily offering to the real estate investor a 9-month fix and flip loan and a 12-month bridge product. During and leading up to and through the COVID crisis, we have been active and have remained constant with our offerings to the marketplace. We've been careful. We've been underwriting what seems to be stronger borrowers that are coming to us online, and existing borrowers that are coming back for repeat business. We had what would be probably a on par closing month in the month of April. We're anticipating a closing month in May to be 25% above our average month. Payoffs through the month of April were also a little bit higher than normal, which was encouraging to us as we saw our borrowers being able to transact in the markets where they are. And that's really from Boston to Florida, across the Southeast and the Rust Belt states and through the Southwest. So we're obviously, as most lenders, sitting on the first 10 days of May, looking at collections. Through the first 6 days, it appears that we're in line with what occurred in April and what occurred in March. And so I guess moving to the next screen, the the offerings that we still have in the marketplace is a fix and flip loan at 9 months, which is a 10% interest rate with 100% funding up to 70% of the after repair value and 3 points of origination, as well as a bridge rental product that's a 12-month product at 9%, 70% loan to value advance and 2 points. We had to, I guess, take our longer term rental product off the shelf right now, given the state of affairs in the capital markets on Wall Street. But we're working to try to bring some product, might be shorter term in nature, might not be 30 years, but it's looking like it might be a 5-year product. We're hoping to launch that in June. We're working through a couple of the details, but other than that, we've been, I guess, sitting on the edge of our seats as everybody through this process, cautiously optimistic that if things open back up, we'll see a recovery that's in line with, you know, the more optimistic side of the coin than we're hoping for a V-shaped curve versus a U-shaped curve. And so far it looks like we have an opportunity to do that.
Awesome. Thank you, Paul. I appreciate that insight. Next up, we have Jason with Armanino. Take it away.
Melissa, thanks for the handoff. So Jason Gilbert, a partner with Armanino, CPA firm, heavily involved in the real estate fund practice. I co-lead our internal focus in this area. I'm more on the advisory and the audit side of the house, and we have a handful of partners here that are dealing with the tax regulations and making sure that our fund managers are getting K1s and REITs are staying in compliance. So if you will, let's roll to the next slide. All right, so everyone's want to know what tomorrow looks like. And before we get there, I want to talk about where we were even 6 weeks ago. 6 weeks ago, we had a heavy push within our firm to reach out to fund managers that we thought it was important to talk about loan loss reserves and yields to investors. Right now, when the markets were down and negative, it was much more palatable to your investor base to hold back on the yields. Not that the corpus was impaired, not that you were underwater in a fund management state, but the fact that, you know, if you come to them and say, hey, we were paying an 8 and now we're going to pay a 6, most of the investors go like, yeah, I get that. I understand, right? It's best practices. We're going to set aside more in the loan loss reserve. Let's prepare for what's going to come. Now, as we sit in the first week of May, I think a lot of people are getting a little more line of sight into where we're sitting, right? Where are things heading? Where are things going to go? More forbearance agreements, not a ton, not a windfall, right? Not a overwhelming deluge of, you know, borrowers coming to the tables asking for forbearance, but you're getting more, right? We're seeing a little more. And what does that look like? So the one thing I'll tell you across the board, it is best to over communicate, right? The funds that we worked with during the, you know, the last recession, and that the funds that were junior trustee funds, right? Not even first position, but junior trustee only funds, right? The ones that just got wiped and killed, those that over communicated didn't end up with lawsuits. They ended up with litigations, right? The investors understood, listen, we're going to get it while the getting's good. Now we understand that we're in a bad position. The corporate's going to walk away. Just be prepared for that. They over communicated, they ended up fine. So the one thing I'll say right now is that your investor base, be very clear upfront, but don't create fear, right? Don't go beyond the limit of like causing fear mongering and, you know, creating a run at the bank, because then that's going to lead to a run on redemption requests. So be clear, be concise, be upfront with what's going on, what you're seeing, what you're doing to protect ourselves, how we're moving forward, so we don't end up with the run on redemption requests. Across the board, I haven't had a lot of fund managers saying they're getting run on the bank. Obviously, there's some investors that get spooked, right? And they come in and say, hey, I want to put in my request for my 30-day notification for withdrawal and redemption. And most of the funds that we work with are putting up a gate. They're holding out at least for Q2 and going to wait until, you know, 7/1 to be honoring those first redemption requests and see how much that, you know, pipeline of need is. We think that that's probably the best way to handle it and make sure that we understand, you know, is this a V, is this a U, is it a W? Where do we stand, right? Where is it going to go, and how bad is the hit actually going to be? And we don't want any of the investors, whether they stick around or they decide to leave, to get an unnecessary hit or benefit by choosing to do one or the other. So let's work through that. We've come with some ideas on if you have decent amount of investors that need to take money out, let's find a way to make it equal, equitable amongst the investors. So we've worked through some of that stuff, you know, and whether you do a holdback or you tie it to the portfolio, you got to work through that and make sure it's administratively not a nightmare to handle, but stuff that's important. And the last thing I'll say is we have quite a few fund managers that are getting calls to say their investors want to place more capital. The hard part there is if you have an existing fund and you got the gates up on the withdrawal, you can't really admit new members, right? That unknown and why you're not honoring redemptions is because you don't know where the fair value is. So if you started letting people in, you're setting yourself up. It's kind of trouble. So I've had a couple conversations over the past couple weeks with fund managers that are talking about setting up fund number 2 and moving down the pathway of, okay, I'm locked up. I can't fund deals. My business is basically, you know, come to not a halt, but slow down quite a bit from where we need to be. What if I create fund 2, launch with fund 2, make fund 1, be an investor in fund 2, assign the performing loans and everything else into fund 2 and get moving down the road. So kind of an interesting concept. It works for some. If you think that, you know, there's going to be some legacy stuff that you got to deal with in fund 1 and won't get back to standard operations by the time we get to Q3, Q4, it may be a decent option for some people.
Awesome. Thanks so much, Jason.
No
next up, we have Jenny with Partners Engineering and Science. Take it away, Jenny.
All right. Hi, everyone. Well, I'm Jenny Redland. I'm with Partner Engineering and Science. We are the third-party due diligence provider for those of you that are finding yourselves still active in this market. Go ahead and switch to the next slide. I thought it might be interesting to share a little bit about what we're seeing out there because we are across all different types of lenders and all asset types. Generally speaking, I would say that the overall market in April was down about 50%. Again, that's across everything. Hotel was down 100%, basically. They are hurting probably the worst. Some lenders are completely sidelined. They've just decided to put lending on hold altogether. And others, like Fannie and Freddie and some regional banks, are just requiring different underwriting requirements, like various reserves and prepayments, that type of thing. A lot of the acquisitions that we did have signed up and ready to go, a lot of those fell out. Not all of them, though. So that's just kind of the 30,000-foot look from our perspective as, you know, the provider of the environmental reports, property condition assessments, ALTA surveys, zoning, all that kind of transactional type work. Go ahead and switch to the next slide. So for those of you that are finding a way to make it work, we are still here helping the folks that are making it work. We do have different protocols in place. We are lucky that we have 40 offices and over 900 employees nationwide. So the airline issue and traveling, we've kind of stopped traveling our people, but for the most part, we can get to places. And then for sensitive property types, we've had a really good track record with doing kind of virtual assessments. I mean, look at us today. We've kind of moved on to this new way of still communicating. Normally, I'd probably be at a conference today, but here I am on a webinar. So similarly for our site assessments, we are out there virtually doing site assessments. You know, maybe we're still at the property, but we can't get into the tenant space, so we do a video chat with the tenant in order to tour the interior of it. Obviously, nursing homes are sensitive as well. Those types of properties we're probably not going to get into 100% inspection. With that, we also have a very robust construction risk management services group, and obviously a lot of folks on the call are involved in construction lending. So I'm going to hand it over to Brian Ward, who's the head of our construction services group, and he'll talk about the extra set of issues that are involved with construction lending.
Thanks, Jenny. As Jenny said, I'm control the construction arm of Partner Engineering and Science, which is a due diligence provider on many of these assets. Essentially, we're the boots on the ground protecting your construction assets. Again, I have a 30-year career in the industry, stemming from originally the engineering side and the construction management side. I have tax credit history behind me, as well as working for the surety side. So I understand how some of these issues will present themselves later on in the claim side of things in construction litigation. So I think I offer a unique perspective on that. So let's if you go to the next slide. I guess I'm here to talk about generally how do you manage your construction or construction process during this period. And the first item there says really know the status of your project or projects. And it may sound a little silly, but there's still a lot of confusion out there. As we get into, and you'll see next, the two elements I mentioned are continue as normal or impacted. And you'd be surprised, a lot of construction was excluded or carved out of the initial stay-in-place orders. So you might just make the assumption, oh, my project in New York City, all the media attention is shut down. Well, that may not be the case. There was a lot of exceptions for affordable housing or just housing in general. Larger projects, is the next bullet point, also get exceptions. I have connections here in the Philadelphia area, and Pennsylvania took a really hard line with construction. Talked to my ex-general contractor friends, and they said most of their projects they were able to get exceptions for and didn't miss a beat. So first point is, know where your construction project stands. Is it continuing or is it impacted? If it's impacted, why is it impacted, right? Is it one of the governmental orders? Is your developer just skittishy? He's got other projects. Your GC, again, is he the one impeding progress? Or is it your inspector, your inspecting agency? We've heard a lot of news about the municipalities not being able to give your inspections, whether it be your rough-in inspections or things like that. I'm sure entitlement processes on the initial end are also slowing down. And if it's impacted, you want to know how long. Again, the news today, and I've already heard mentioned on this call, is that some of these orders are being lifted earlier than they would have expected. Pennsylvania, again, where I'm located, kind of put the call back to work for all construction projects on Friday. I think Washington was issuing something yesterday. So many states are, or on Monday, I should say. So many states are already relaxing the initial reduction on construction projects. So know your projects. And the next slide, what do you do during these times if you want to control your funds and you want to maybe not have more say in your distributions? Is again, implement tighter controls. And the first way to do that is know what your agreements say, what they allow for and what they don't, and be able to take advantage of the documents that you have with your clientele. And most importantly, in these times, is do not let the project distribution, the funds, get ahead of the project. That's a recipe for disaster for any of us who've been in construction claims or had projects go bad. As I used to always say with the attorneys I've always worked with, is follow the money. And it's no different during these times. So some of the steps, again, are physical inspections, more likely to impact projects. I think Jenny mentioned even in her realm, where there's resident populations and in large urban areas like New York City and the Bay Area, maybe Detroit. There's also, if you watch the news, there's some hot spots showing up in some rural areas. So know where your project's located, and you may have an idea whether it's being impacted, whether the ability to get physical inspections is being impacted given its geographic location. There's also been a large acceptance of alternative inspection methods, as Jenny mentioned, the virtual inspections. So we're finding great acceptance for that. Now is the time for your inspectors to be more diligent rather than less diligent, obviously. Some of the developers and contractors have the uncertainty in the future. They want to get as much money as they can right now. So there's what they call this money grab. They're trying to get all the money. So they may be pushing the envelope when it comes to the amount of work that has been completed at the job site or the amount of deposit that the vendor really needs. Again, everybody's trying to get all the money during these uncertain times as much as they can. And understand that the money to a borrower doesn't necessarily mean that funnels down to the people in the field doing the work who potentially can put your liens and stuff like that. So you gotta watch and be diligent through the whole trail. And again, you can use some elements to control your distributions. If your agreements call for physical inspections, for instance, you may not have to accept a virtual inspection. And so if you want to delay your distribution and you want to force physical inspections, that may in essence be a way to control the fact that a draw request or the distribution of funds will have to wait until the regulations relax. again, I mentioned kind of briefly already, deposits and stored materials. Now's the time to require all the documentation. No more shortcuts or exceptions. We deal with lots of projects where under normal circumstances, 80% of the documentation is good, and you let it slide. Maybe time to reconsider all that and tighten up. The same thing on general documents required. You may want to tighten up on all the requirements for things as pay applications and your waivers and your requirements of permits, evidence of things that they self-performed. Again, you can use these as a way to control distribution if you choose to. So eliminating previously allowed exceptions is one way that you can tighten up. Hey, I know before we let you go without all those waivers, but now we want all the waivers you're looking for. I know we didn't require that payment application to be notarized, but now we want it to be notarized. And so in general, again, know your documentations, know what your documentation, your lending documentations allow and don't allow. Use it to your advantage. And like Jason said earlier, over-communicate to your clientele, to your borrowers, let them know where you stand. Again, I don't think it's a good idea to withdraw or to mitigate distributions to good projects and good clients, because you're obviously just going to impact your interest in that regards. But these are some of the things to look out for, and some of the things we're seeing across the country as, again, a third-party provider, your boots in the ground per se. Melissa?
Awesome. Perfect. Thank you, Brian, and thank you, Jenny, as well. Moving on, our next speaker is Boots with RRA Capital. Take it away.
Yeah, thanks. Boots with RRA Capital. I'm the CEO and co-founder. Our firm was started in 2008. We started originally as institutional consultants and asset managers on commercial real estate debt portfolios. In 2013, we started an investment management practice where we became commercial real estate bridge lenders, and we've sort of evolved that into pref equity and mezzanine as well. We focus on the $20 million space, do all product types: office, industrial, multifamily, retail, self-storage, hospitality, RVs, mobile homes. There's really nothing we don't do. However, we don't do land or construction. We are non-recourse lenders, and we typically lend in the all-in interest rate of roughly between 5.5% and 8.5% for senior mortgage debt, and then typically for pref equity, it's in mezzanine. You're looking at mid-teens. Average duration of our loans are typically 1 to 3 years. As far as changes with our underwriting and our lending parameters, I'd say that our pricing hasn't changed that much, but our advance rates have changed, fairly drastically. So we pre-COVID were lending at 85% loan to cost or LTV on certain product types. We've since kind of dropped that on average, roughly, 70%, depending product type specific. Obviously, retail and hospitality were lower, and perhaps multifamily or industrial maybe still a little bit higher. But I think on equivalency perspective, based off the lower advance rate, we're probably about 150 basis points more expensive today than we were pre-COVID. One thing that we're doing is a lot more interest reserves. So as we're looking at different product types, particularly retail, and then, student housing, assisted living facilities. We do some schools, we're requiring, anywhere between 9 to 18 months of interest reserves. We, on some deals that, it's still uncertain what the permanent effects of, societal effects will have, of COVID-19, how that will affect the way we work, that we feel as though with a lender with little to no upside, it's not worth doing the deal. However, we have structured with some of our borrowers on new originations some profit sharing components. So we can, take that risk alongside them, but be able to, participate in the upside. We're also doing a little bit more PIK type loans, particularly in the mezz and pref equity, where, we're trying to pick up more fee on the back end when it pays off and they meet their business plan. Just trying to align incentives and get paid for what we believe is the additional risk that we're taking in the market. As far as forbearance requests, and I don't know if I'm getting ahead in in answering these questions. But we don't have, fortunately, we've been lucky in our bridge lending portfolio. We don't have too many requests. You know, I appreciate one of the earlier comments about how you have to be very careful not to make sure you're getting taken advantage of. So we're pretty judicious in proving, you know, having borrowers prove their need for forbearance. However, in our third-party asset management portfolio, we do have a lot of forbearance requests, particularly in retail, which is no surprise. You know, one thing that's important, we do lever our product, our loans. And so interestingly enough, if we initiate forbearance, we can take that loan off of our line and put it back on when it comes back to performing. However, if we don't offer forbearance and the loan goes into default, that loan permanently can't be put back on our credit facility lines. Or at least there's, you know, that's not in the current agreements. There'd have to be a discussion. So I will say that there's a little bit of playing chicken with some borrowers right now, but ultimately the way we're looking at it is, you know, we would rather, you know, offer forbearance than truly have a default, because our ability to put that loan back on the line down the road could be challenged. As far as when we anticipate lending again, so we are lending right now. We've had a lot of deals that were transactions that fell out from, you know, traditional lenders pre-COVID, but were mid-transaction during the crisis. We've seen that fall off, particularly within the last week, dramatically. We're anticipating the sort of new acquisition activity and even refinance activity over the next 6 months, probably 6 to 12 months, will be next to little, just because a lot of lenders will be making modifications on existing refinances, and there's just not too many investors that will be able to agree. We think the bid-ask spread over the next 12 months is going to be too far for really a lot of good transaction activity. So we're trying to figure out, you know, how to deploy capital, you know, in the next, you know, 12 months. And so that is going to be one of our biggest challenges. Getting to the next question, we're looking at secondary note acquisitions and trying to buy performing and sub-performing loans that maybe aren't hitting their maturity dates from other lenders. You know, another topic that was mentioned is, you know, just general profitability. When you're a shop that's a private lender, you do make a little bit of fee, hopefully, on putting out money. And so if you're not making that fee, it ends up being more difficult to cover your overhead. So, you know, that's always a concern, particularly when you need to add more resources to your current asset management in order to work through stress in the portfolio, as well as possibly even add more resources into sourcing new opportunities, because there'll be so few. And then also underwriting, because it's a very difficult environment to underwrite. So, you know, you know, my hope, is mentioned earlier, is that we just break even. But, you know, that's going to be an ongoing concern. And then lastly, I think the general uncertainty, you're looking at close to 40 million unemployed. That's roughly 24% of the total working population in the United States. If this is worse than the great financial crisis, which, you know, is looking back at, real estate really got built out by foreign capital, and there was still, you know, the whole globe wasn't in recession. Oil and gas was doing extremely well, and a lot of that foreign capital that came in 2010 to 14, particularly in the primary markets, helped start that engine. So really looking for where that capital is going to come from in this next cycle, along with, you know, so many other factors that include, you know, how social distancing changes things. And also, you know, whether or not, you know, we've got a pretty strong dollar. Last time it was pretty attractive when you had a lot of foreign capitalists coming in, because the dollar wasn't as strong. So we're looking at all those things, but very concerned that this could be longer and deeper than the last crisis.
Excellent. Thank you so much, Boots. I appreciate your insight as well. So next up, we have me. My name's Melissa Martirella. I'm an attorney here at Aussie LLP. In a normal environment, what I do on a day-to-day basis is draft loan documents and provide lenders with lending compliance advice all across the country. That's pretty much the bread and butter of what we do. In addition, I manage the firm's foreclosure practice here in California. Right now, things are a little bit different. So the majority of my day is spent talking with lenders, talking with brokers who have issues with loans, borrowers defaulting, questions about forbearances or modifications, just really helping our clients walk through some loss mitigation steps. So a couple of things I wanted to talk about with you guys today. First, we have a little map here. This is a patchwork of foreclosure prohibitions. It's current as of Friday afternoon, but note that things are definitely changing on almost a daily basis. So, this is just a general big picture overview. All of these states in red have some sort of restriction on foreclosure in the country. So it might be a statewide restriction, it might be countywide or even citywide. Might affect residential and commercial properties or only residential. Some only affect consumer loans, and then others actually affect business purpose loans as well. So it's really a very complicated patchwork, but we do have all of that if you do have questions. So I strongly recommend, the takeaway here is that you reach out to counsel before you start a foreclosure in any of these states, or really any state in particular, because things are always changing. It's something to keep your eye out on. Kind of talking a little bit more about that, it is a moving target, these prohibitions. It's literally changing every day. So, something that was okay yesterday may not be okay today. So keep an active watch, especially in the states where you're lending. As an example of this, California Assembly Bill 828 is pending legislation right now. If this bill does end up passed, it will prohibit the county recorder's office from recording a notice of default, a notice of sale, or a trustee's deed upon sale until 15 days after California lifts the state of emergency. And this is going to affect any loan that is secured by a 1 to 4 family residential property. It doesn't matter if it's a consumer loan or a business purpose loan, any loan secured by 1 to 4 family residential property in California would be affected by this. So the bottom line here is, if you're intending on foreclosing, you should probably do so now if it's still possible, because people are talking about restrictions. California's got this bill, other states have proposed legislation. So it might be okay to start today, and in which case, if it does make sense and you've reviewed your file and foreclosure is the next best option, jumping the gun and getting on that is probably helpful for you here. The next big issue that we've been hearing from our clients hasn't completely come to a head yet, but it is something that people are talking about. It's dealing with loan sale agreements and what happens with early payment default repurchases. So big picture, what is this? If you are a lender and you're selling your loans to a loan buyer, you probably have an MLPA or a master loan purchase and sale agreement in place with that loan buyer. In that, there's usually a provision regarding early payment defaults. And what this means is, usually within the first few months of you selling that loan, if your borrower ends up defaulting on the loan, that loan buyer can require you to repurchase the loan from them. Most buyers right now are not triggering this provision, but there are a lot of questions that we've heard that come out of this. What if the loan buyer provides the borrower with a forbearance and then they default under the forbearance? Are you liable at that point in time? Or because the buyer provided a forbearance, now they're assuming any early payment default? What about an interest holdback? What is that true first payment that they would be missing? It might be 6 months down the line if you have a large interest reserve. So you really have to know what your agreement says. And so big picture, it's, really, what does your agreement say? A well-written agreement is going to outline for you what happens when there is a default under that loan, and whether you as the loan seller will have any potential obligation to either repurchase or any other liability under that document. So if you have any questions, we'd be happy to help walk you through what your MLPA says with you. And then the last thing here, a couple of our panelists have talked about it, and we've, the last AAPL webinar that we did, we went over in depth about forbearance requests and the best practices there, but this is still a huge issue. Most of the requests that we're seeing right now are for forbearance agreements right now, and we expect May to be worse than April. April at the beginning of the month, at least it was still kind of fresh. People were still working through most of March. So we're thinking that May is going to be a little bit worse, and maybe June, as far as borrower defaults or borrower's inability to pay. So big picture, Last webinar, AAPL and Aussie created a forbearance request form. We can provide that to you after the webinar. It's also on both of our websites. We recommend that you take this form and either put it on your website or give it to borrowers who are saying that they have a hardship with making loan payments, so that you can get the proper backup documentation to determine whether it's a legitimate forbearance request. It's definitely something that I would strongly recommend you keep in your file, because especially if you end up denying that request for a forbearance, it's good evidence to show that they did not qualify for one. And then in the event that they are truly going through a hardship, it outlines the backup documentation that that borrower would need to provide to you to evidence that. So it really helps keep this process organized. And then in the event, again, as a reminder, if you do decide to move forward with a forbearance, the best practice is to really be generous to the people that are in need right now. So AAPL and Aussie, these are our best practice recommendations. So provide a temporary forbearance of monthly payments, or maybe that maturity date payment if that's coming up in the next couple of months here. Usually you're deferring those payments until maturity. It's usually a 60 to 90 day payment deferral. If it's an amortized loan or a longer loan term period, sometimes we're seeing catch-up periods in next year, whereby the borrower can make up those missed payments throughout the course of the year without being in default. And then the last thing here is really we aren't seeing people charging default interest, late charges, capitalizing interest, or charging additional fees during this forbearance period. If people are truly in need, they probably, would be really harmed by adding these additional charges. So we recommend being as helpful as possible to these borrowers. That doesn't mean you can't charge anything for it. Obviously third-party servicing costs, documentation costs, things like that. There is a cost associated with drafting a forbearance, but we're talking about fees like, additional points or anything like that. Generally, we would, say in a normal market that you could charge those. In this case, I would probably avoid doing so. So that's all I have. Kevin, if you'd like to take it away as well.
All right, thank you, Melissa. Hi, everyone. This is Kevin Kim, partner here at Aussie. I manage the firm's corporate and securities team. So I'm a SEC attorney, so we focus primarily on fund formation for the private lending industry. My team and I have created hundreds of funds across the country, pretty much exclusively for private lenders. I'm also the lead instructor for AAPL's Certified Fund Manager course, which is now online. And that focuses on compliance with respect to securities regulations, fund design, and compliance. Today, I'm really here to talk about what we're seeing in the middle market as it pertains to funds and other capital structures out there based on asset class, and then also some specific issues associated with investor relations to expand on what Jason discussed earlier. As my colleagues in this call today have discussed, we have seen a considerable tightening across the board, depending, regardless of asset class, much more on the residential side. I mean, it really is echoing all the sentiments we've heard today. The one thing that is interesting, though, is folks have, at least fund managers who have discretionary capital who are offering residential mortgages are realizing that they are getting significant enough opportunities to continue operations. And they are realizing that they are not as poorly positioned as they feared. That may be temporary, but the month of April was not as scary to them as they thought it would be. The month of May is showing to be somewhat productive as well. And so, what I have been hearing lately, and the majority of my day is speaking with my clients and other fund managers across the country about what they're seeing, what I'm seeing, what they can do to resolve whatever issues they're facing. And so what we're seeing on that front is folks are trying to establish a new sense of kind of going forward business model that's not overly conservative to the extent that they are restricting their borrowing base. And the reasoning behind that is they have the capabilities to manage assets, if you will. Of course, they're not taking on asset classes that they consider to be unnecessarily risky. For example, tertiary market state construction projects, things, they're definitely focusing on local geography. But I have seen a kind of attitude shift toward let's see what we can create from a business model now that we kind of have a feel for what our borrowers are able to do. On the commercial side, as Booth said, our lenders who are our clients who are managing funds or have discretionary capital associated with that, they are exiting away from retail and hospitality. I can only name one off the top of my head that is still doing hospitality, and I still can't understand why, but he feels he can handle it. So pretty much, aside from those, the commercial bridge market and the commercial real estate market, when it comes to the lending side, is still operating pretty efficiently. They have kind of fallen back to their funds and their investor bases, as opposed to the bond market or whatever have you. The bigger topics come along the lines of investor relations. So as it pertains to investor relations, last month April was the month of announcing a significant increase in reserves, not returns, a reduction in returns and reduction in expectations associated with those returns, and the challenges that come with that. I would say majority of funds have not halted distributions altogether, although they have suspended or soft suspended exits and withdrawals. And that has led to the issue that Jason has discussed earlier. How do you bring on new investors associated with that? As counsel, we typically advise them it's a matter of disclosure and advice, but there is a significant kind of chilling effect when it comes to not having a clear exit strategy if you're a new investor. But all of this comes with, the bigger part of this is not necessarily just notifying people in writing, but a multi-pronged campaign and advising on that front. We're spending more and more time with clients, advising them on their investor relations strategies, and delivering these messages, because while you can do the bare legal minimum, we have enough anecdotal evidence based off of our years of litigating these types of cases that there are some best practices that they should be following. I've been harping on this in every AAPL call, and also in other webinars. But the in-person, the over Zoom, the phone calls, the be available, those types of things, having a strict program around having that human touch is going to go a long way, being transparent and owning up to it, and also having the data to back it up and back your decision up. And then the last thing that we're also seeing is that that sponsors, lenders, fund managers, asset managers, whatever you want to call them, are now significantly testing the waters, if you will. They're speaking with their investor bases. They're asking them about opportunities they want to pursue, in preparation for pursuing the opportunities that come in this market. And I'm not a doom and gloom guy, but we have to discuss this. So let's go to the next slide here about the opportunity that we're going to see. So it would be foolish if I didn't actually discuss this in reality. While I do not like discussing doom and gloom, it is a reality of the world we're facing. So and not just our industry. It primarily will come from the other segments of the residential finance industry. So it'll probably come more from the non-QM and the conventional markets. But primarily, the point here is, a vast majority of my clients are already prepared or getting prepared to pursue some type of opportunistic investment, whether that be an NPL, RPL strategy, or purchasing just performing debt at a discount, pre-COVID debt on balance sheet to free up capital for other lenders. On top of that, we have discussions with many folks outside of our industry and within to pursue strategies to purchase distressed real estate and also businesses. And prepare a business plan surrounding financing opportunities from that front, but also equity positions in that front. Two particular examples in that arena for the real estate side of things. We've had discussions with folks about one example was you're going to have a lot of distressed hospitality, 2-3 star projects, 2-3 star hotels, medium level flag, and to that extent, maybe convert that into workforce housing or temporary housing or corporate housing or short-term housing, and getting the permits for that. Rescue loans for businesses and opportunities to refinance out of distressed or defaulted bank financing or SBA financing is also going to be something that's coming up. Back to the mortgage sector, a lot of our clients are having a challenge because, they're not quite equipped to, or they get a little bit of analysis paralysis, if you will, in preparing to pursue a strategy to go after opportunistic investments or distressed investments. And I'll tell the group today what I tell them every day is that the institutional markets, the private equity markets, the hedge funds, the pension plans, the fund of funds, they all are amassing or have amassed their dry powder, and they are already moving quickly. And the advantage that you have and that our membership has over those groups is that you are on the ground, you are dealing with borrowers, you are facing the market itself. And I would strongly encourage folks who are considering this to take it very seriously and get ready, because the last thing you want to do is be bidding on a retrade or a second or third retrade and enter into a pricing war, or having to purchase things that just don't make sense anymore, and all because it's just a matter of timing. So I strongly recommend folks, if you're thinking about this, if you're committed to doing something like this, speed is going to be your best friend here. We have spoken with a large number of what I would call GSE servicers in the Fannie Freddie market and conventional market and non-QM market on the servicing side, and they're all of the same sentiment that 90 to 180 days will be the window before the ish hits the fan, if you will, and their clients are getting ready. So that means, for you guys out there, if you're thinking about this as an investment opportunity, I would strongly recommend you prepare now, because it takes time to get ready and amass capital. So that's really all I have from this slide. And for today, I don't really have anything else. I think it's time to go to questions now.
So real quick before we get to questions, as a reminder, we've got a couple other webinars and other online events that are coming up. So I just wanted to let our viewers know. First, we have our Jurassic Lender Connect conference on May 20th. It's a fully online conference. As a lot of our panelists have been talking about, we've been, missing going to conferences, talking to people, networking, getting education. This will be an opportunity for that. So if you have any questions, feel free to go to our website and we can get you, an update on what that is and see if you want to register. In addition, we have a series of webinars coming up that will take place at 11 a.m. Pacific on the days below here. So the first one is actually coming up tomorrow. It's on canceled contracts and how you should manage contract disputes during this current COVID-19 outbreak. Next week we have two. One is on bankruptcies and how to manage that as a lender or a creditor. What are your rights and responsibilities there? Next Thursday is a discussion about qualified opportunity zones, issues that have popped up, new regulations, extensions with that. And then the following week, we have another one regarding loan origination fraud 101. So if there's any, obstacles or remedies that might be helpful for litigation or bankruptcy, we'll be discussing that then. So if you have any questions, we'll be going over those now. Otherwise, as Eddie mentioned at the beginning, these are some helpful links for you to follow up with us here. But I will go through, we have 2 minutes, so hopefully we can get through at least one question. They are all about foreclosure. So the first question that we have here is, how widespread across the country are moratoriums on foreclosures? Do they apply to commercial hard money loans? Yes, some of them do. Most of them are still dealing with consumer loans. That being said, for example, if that California that California bill were to pass, that would deal directly with any property or any loan secured by 1 to 4 family property, regardless of if it's business or consumer purpose. And then I do know several states have restrictions on all foreclosures, regardless of business or consumer purpose. So it really depends on the jurisdiction that you're looking at. And then as far as the likelihood of that passing, that California regulation, we don't know yet. It's still in committee, it's still being reviewed, but it's something that has been brought up several times over the last month. So it's something that we are definitely watching. And if it does end up passing or looks like it's about to be passing, we will definitely keep you updated so that you know. And then one last question here that I think I'll just pose to the group. Are these new originations post-COVID-19, or were they in the pipeline? So if any of the lenders here, if you had new origination loan originations that you're moving through right now, were these previous deals that you were looking at, or are they ones that are coming up after this pandemic?
I can answer that. They were deals that were not in our pipeline before COVID-19, but they fell out with other lenders. So they were deals that were in the process of transacting with another lender pre-COVID-19 or at the early start of it, and then came to us afterwards.
Anybody else want to jump in on that? Okay, well, that being said, this is all the time we have, and these are all the questions that we have. So if anything else pops up, you have any additional questions, feel free to reach out. We can follow up with you. And again, this has been recorded, and the slides will be available to you after with some follow-up materials. Thank you all so much for attending. Have a wonderful rest of your day.
Thanks, Melissa.
Yeah, thank you, Melissa. Thanks.
Thank you.
Thanks, everyone.